Ladies and gentlemen, good day and welcome to the Sapphire Foods India Limited Q2 FY23 earnings conference call. As a reminder, all participants are in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please press *0 on your touchtone telephone to signal for an operator. Please note this conference is being recorded. I would now like to turn the conference over to Mr. Nachiket Kale from Orient Capital. Thank you, and over to you, Mr. Kale.
Hi, good evening everyone, and welcome to Sapphire Foods Q2 and H1 FY23 earnings call. The management today is represented by Mr. Sanjay Purohit, Group CEO and Whole-Time Director, along with Mr. Vijay Jain, CFO. I hope everyone had a chance to go through the investor presentation and earnings press release. Before we begin, just a reminder that this call may contain some forward-looking statements which do not guarantee future performance and involve unforeseen risks. With that, I'd like to hand over to Mr. Sanjay Purohit to take over.
So good afternoon, ladies and gentlemen. Welcome to our Quarter 2 highlights. I'll talk very briefly about the numbers and then I'll give you a color on the quarter. In the quarter, we delivered a strong performance. Our revenue was our highest ever at 506 crores. Our EBITDA was at 103 crores at 18.4%, up 350 basis points year on year. And our adjusted EBITDA was about 62 crores at 11.1%, up 490 basis points year on year. PAT stood at 27 crores, 4.8% of revenue, up 600 basis points year on year. Our India restaurant EBITDA grew by 40 basis points year on year. However, due to the adverse Sri Lanka impact, consolidated restaurant EBITDA of 16.8% was actually lower by 50 basis points. And all of this I'm looking at versus our normalized EBITDA of Quarter 2 FY22. And if you remember, last year we were painstakingly calling out that our EBITDA was actually lower than what we had repeated because of one-time incentives that we had got on our store openings. So against the normalized EBITDA numbers, India grew by 40 basis points, but on our consolidated level, we dropped by 50 basis points. So, restaurant EBITDA. So, what was the quarter like? So, at the beginning of the quarter, we thought it's going to be a challenging quarter. One, KFC revenues, especially for the Sapphire markets, are especially impacted because of the higher festival vegetarian days that we see. And I'll say this year, the extent drop that we see on vegetarian days has gone back to 2018-2019 levels. So there has been quite a severe drop versus say last year, but in line with what we have seen perhaps in the earlier years. So that was one potential negative impact. The second potential negative impact was that inflation peaking, and in both the brands, we were seeing mid-teens inflation levels. Therefore, at the start of the financial year, along with Yum, we had consciously taken a call to have price increases not in line with inflation, but lower price increases, so as to ensure that our transaction volumes are maintained. And that has worked really well for us from a demand perspective. So we are really happy with how the quarter has gone from a demand perspective. If you look at our same-store sales growth, have been really strong. Our year-on-year ADS levels have been sustained in spite of 176 stores that we have added in the last 1 year. So I think the fact that SSSGs are strong, transaction growth has been maintained in spite of in spite of our price increases. I think that bodes well for the. So if you look at KFC now, we delivered a 15% same-store sales growth and a 36% increase in overall transaction. When we look at a channel level, actually dine-in was quite strong, and their transactions also grew on a year-on-year basis. But because our price increase, which we had taken in about between 9 to 10%, and like I said, inflation was in mid-teens, our gross margins were impacted by 310 basis points. But because of leverage that we got on 15% SSSG and tighter cost management, our restaurant EBITDA was, the drop in restaurant EBITDA went to about 80 basis points versus the normalized EBITDA level of 18.7% in Q2 FY22. You would have heard both Vijay and me talk about Q2 being generally the lowest quarter for our KFC perspective, and it drops versus Q1, and then we hope to recover in Q3, as we go past the festival and vegetarian days. So this time we were able to restore. Gross margins went down by 310 basis points. Our restaurant EBITDA margins just went down by 80 basis points. So the SSSG focus as well as the cost management focus helped us to curtail this drop. On Pizza Hut, I think we have had our best ever quarter. Our same-store sales growth grew by 23%. There was a very strong transaction growth in excess of this SSSG. And there's ADS growth both over the corresponding quarter and the sequential quarter. And therefore, even when gross margins dropped by 110 basis points, our restaurant EBITDA was our highest ever at 15%, up by 440 basis points compared to our normalized restaurant EBITDA of 10.7% in Q2 FY22. So here, I'm happy to say that a combination of our omni-channel strategy, where dine-in, takeaway and delivery, all three come, we are able to maximize revenue out of a store through all three channels, combined with combined with all the work that we have done on cost management, as well as the innovation on Pizza Hut, the same-store sales growth has been very strong at 23%. Our Sri Lanka business also had a strong quarter, and we grew SSSG of 30 to the tune of 37% in L terms. Now this has largely been on the back of price increases, so the transaction growth has been just about positive in this quarter. Inflation has continued to rise, and therefore our gross margins have got significantly impacted, and therefore restaurant margins also dropped to about 550 basis points to 15%. Versus our normalized restaurant EBITDA of 20.5% last year, Q2. Absolute value EBITDA grew by 23% in Lankan rupee terms, but in Indian rupee terms declined by 25% the currency translation impact. Largely, if you see in Q1, we delivered in Indian rupee sense roughly about 7 crores. In this quarter also, we have delivered similar.
Roughly 10 to 11% mix of our corporate EBITDA.
Yeah. We are also happy to say that our restaurant expense pace has steadily, has been steady. We opened 42 restaurants in Q2 20 KFC, 14 Pizza Hut in India, and 7 Pizza Hut and a Taco Bell in Sri Lanka. So given all the macroeconomic conditions that we are seeing, many consumer product companies showing lower transaction growth, lower volume growth, our inflation being quite high, the fact that we consciously took lower price increases in the hope that we will be able to maintain transaction growth. I think this quarter has been actually a very strong quarter for us, and we are quite happy at the way that it has panned out. Coupled with our restaurant expansion, that means that we are in a reasonably good space. As we look at quarter 3, there will be some amount of, so quarter 3 is generally better than quarter 2, and we expect some amount of, marginal amount of gross margin improvement towards the end of quarter 3, perhaps beginning quarter 4, but inflation continues to be at the same level, so there's no drop in inflation level. So that's the overview. When I look at page 7, the consolidated financials, you'll see, I'm repeating myself here, 560 crores, up 36%, adjusted EBITDA 52 crores, up 144%, 62 crores translates into 11.1% adjusted EBITDA margin. EBITDA was 103 crores at 18.4% and PAT 27 crores at 4.8%. We ended the quarter with 658 stores, 301 KFC, 249 Pizza Huts in India, and 106 Pizza Hut and well in Sri Lanka, and 2 stores in Maldives, so totally 658 stores. I'll now quickly hand it over to Vijay, who will talk about the specific financial highlights.
Good afternoon, everyone. I'll move on to slide number 9, consolidated financial highlights. Slide number 9. So we clocked sales of 560 crore, highest ever revenue, growth of 36%. Gross margins we dropped by 310 basis points. We'll deep dive into this at each business level. Moving on to slide number 10. Slide number 10 is a bit busy. At times when you do over disclosures, it can have this kind of effect. So I'll take a bit of time on this particular slide. If you look at numbers in brackets, which are given for last year, corresponding quarters, those indicate normalized restaurant EBITDA numbers, taking aside one-time benefit which we received from YUM on account of COVID, additional incentives which we received. We had called out this last time as well in quarter 3 financials when we released. So on a comparison to a normalized last year, restaurant EBITDA of last year of 17.2%, we delivered 16.8% this year, a drop of 50 basis points. If you look at the note below the graph, it says India restaurant EBITDA grew by 40 basis points versus last year. So after excluding the Sri Lanka business, where we have seen a big drop on Sri Lanka, the India restaurant business grew by 40 basis points in spite of a 300 basis points drop, what we have seen at an overall level. On adjusted EBITDA at 11.1%, it was up by 750 basis points over last year compared to a normalized EBITDA for quarter 2, which was 3.6% last year. In terms of value, we delivered 62.4 crore. Quarter 1 for us was around 73 odd crores. Slide number 11, overall EBITDA of 103 crores, 18.4%, up by 610 basis points versus last year's normalized EBITDA of 12.3%, and PAT of 4.8% at 27 crores, up by 860 basis points over last year. Last year we were negative on PAT. On an YTD basis, if you look at, we delivered a PAT of 65 crores, which is close to 6%, up by almost 1,000 basis points versus last year. Sanjay would take over on the KFC section.
When we look at the channel contribution, we'll find that dine-in has continued to increase in overall contribution. So in quarter 2, it was at 44%, whereas delivery was at about 36%. And and takeaway was about 20%. We had product launches, chicken peri peri, we had a chocolate lava, a lot of branding and promotions around both chicken peri peri and chocolate lava. Our digital activation continues and the use of celebrities. Our new store launches, we have given you some pictures. Finally, in Sunday, we were able to launch a Colaba store. Recently, in October, we launched a store near Fort, and then we have launched a store in central Mumbai, also near Dadar. You can see the Faridkot Punjab stores. Some of the stores in Punjab are really beautiful. Big stores with full drive-through, and the retail development in these, it's an integrated retail development with a lot of food players, apparel players, entertainment. So the brand does really well here. And you can see a picture of the Jalna Road Aurangabad store also.
Moving on to slide 20 on financials. Very strong SSSG of 15% in the quarter for KFC. Very healthy ADS of 134. Mind you, this ADS is in spite of the 82 restaurant additions which have happened over last 1 year. So it includes all the new restaurants as well. On restaurant EBITDA, slide 21. On gross margins, just let me cover the gross margins first. Okay, restaurant revenue first. On restaurant revenue, we clocked 350 crores, up by 30%. Additions of 20 stores, which took the count past the 300 mark for us in KFC in the last quarter. On gross margins, we dropped by 310 basis points. Two reasons over here. One prime reason that inflation peaked in quarter 2. Quarter 1, while the inflation was there, we were also carrying old inventories. Inflation peaked in quarter 2, that has a major impact. A marginal impact also on account of delivery mix reduction compared to last year. Last year it was 42%, now it's 36%. So small impact also on account of delivery reduction. Our delivery prices are generally higher than our dining and takeaway prices. However, in spite of gross margin reduction, we were able to curtail the restaurant EBITDA drop to 80 basis points. If you compare to a normalized EBITDA of last year of 18.7, we delivered 17.9%. This was possible because of healthy SSSG, which Sanjay spoke about, that we were able to drive because of lower price increase than inflation. Combined with the cost control, we were able to limit the drop to 80 basis points in the quarter. Hence, overall, for a very soft quarter, expectedly soft quarter from a festival point of view, but from an overall demand and SSSG point of view, it was a strong quarter for us. And the cost management and healthy meant that we were able to restrict the impact to 80 basis points. Going forward, Sanjay mentioned that as we move into Q3, we expect a recovery and demand to pick up because the festival days, the vegetarian festival days are over. Gross margin point of view, we expect marginal recovery to happen in quarter 3, beginning of quarter 4. And the higher ADS or higher revenue should enable us to drive greater restaurant EBITDA margins.
From a Pizza Hut perspective, the channel sales contribution is quite similar to quarter 1, where 35% came out of dine-in and about 15-16% comes out of takeaway. So delivery is today about 49-50% of our total business. A lot of our branding and promotions was focused on Flavor Fun that we launched in the end of July nationally. You can see some of our new restaurant launches, and we launched about 14 in the quarter. So you can see Alwal, Gandhidham, Avdi, where we got KFC and Pizza Hut in the same premise and Digi in Pune. And now Vijay will just talk about the numbers.
Slide 28 on Pizza Hut, our overall SSSG was 23%, and as Sanjay mentioned that this was on back of strong transit, which was really heartening to see. In terms of ADS, we were at 64,000. This was not only a growth on sequential quarter, but as well corresponding quarter as well. And this is in spite of 61 store additions which happened over last 1 year in case of Pizza Hut. Restaurant revenue grew by 60% at 140 crore with 14 additions during the quarter, taking the overall tally to 249 restaurants. On gross margins, we dropped by 110 basis points on account of churn, and our price increase generally been lower than the inflation. However, our restaurant EBITDA, when compared to a normalized EBITDA of last year at 10.7%, we delivered 15.1%, which is up by 440 basis points. So this was best ever quarter for Pizza Hut in terms of revenue as well as in terms of the restaurant margins. And within 15.1%, if you guys remember last time we called out that stores which have opened from April 18 onwards over last 4 years, those are delivering mid to high teens level of profitability. And stores prior to April 18, while they are converted to omni-channel, because of their inefficient size, they deliver low double-digit restaurant EBITDA.
Our Sri Lanka business in a economy that is still impacted continues to do well. The highest or the greatest impact of all the disturbances came in perhaps towards the end of June, July and August. But now things are stabilizing from an operations perspective. It is easier to get fuel. There are less number of electricity outages. Imports again been allowed, so we are able to get our imported products also in time, cheese, etc., which is very important. So operating wise, the business is at least I would say 85-90% at a normal level. Inflation, when we look at the first half, would anywhere close to about 75 to 80%. We would have taken price increases in the region of about 40%, and therefore gross margins here have dropped. But ADS at a Sri Lanka level, SSSG grew by 37%, and our store openings continue. We opened six Pizza Huts and 1 Taco Bell.
7 Pizza Huts.
Pizza Huts and 1 Taco Bell. We are also seeing reasonably good traction on Taco Bell, even though it is just 7 stores today. But potentially at some point in time, it could be another driver of growth in Sri Lanka. Our new products continue to do well. So the brand is in a strong position. And when I look at October, there's been a little easing out of improvement in operating conditions. However, inflation is still an issue. And given that wage inflation is not in line with general inflation, there will be pressure on consumer discretionary categories. And from a transaction level, I feel that we will see pressure as we go forward. The quick financials, Vijay will talk about.
Page 36, overall SSSG 37%, with ADS in Lankan rupees at 335,000. If you look at the Indian rupees 873, impacted by translation of currency of almost 40% impact or depreciation. In terms of revenue, in Sri Lankan rupees, 312 crore revenue for the quarter, up by 76%. In Indian rupees, it's 67 crores, up by 2%. So still positive, even though a big impact on translation of currency. At gross margins, a drop of 1,000 basis points, as we saw even in Q1, there was a drop of close to 950 basis points, impacted by inflation. Sanjay spoke about that our price increases were in the range of 40%, while the inflation was in the range of 75-80%. Absolute margin still grew by 23% in LKR terms, while the percentage margin dropped by 550 basis points when you compare it with normalized EBITDA of last year. So it clocked 15%. So overall things are more stable in terms of, as Sanjay said, operating conditions, be it forex availability, be it supply chain management, be it power and fuel. And as indicated earlier, this year we expect probably the overall year where revenue to grow by 20-30% in Lankan rupees. We would be happy if we are able to hold or marginally grow our EBITDA at Lanka level in LKR terms. Of course, we will have a depreciation impact on currency impact of 40%, which means at a corporate EBITDA level on an annual basis, there would be an impact of 15 to 20 crores in Indian rupees. Having said that, the India business is more than able to cover for the deficit on Lanka business, and this now forms only 10 to 11% of mix of at corporate EBITDA level. That's it, guys. Thank you. I'll hand it over to Vikram for the Q&A session.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone now. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star 1 now. We have a first question from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, this is Percy Panthaki here. So my question is on the margins. You mentioned there's a 300 basis points hit on gross margins. So what is the plan to counter that? Is it that you see the commodities coming down and that itself will take care of it? And if so, to what extent? And do you think any more price increases are necessary? That's the first part of the question. And second part of the question is that assuming that you recover this 300 basis points over the next 2-3 quarters, does that mean that your EBITDA margin also versus the 11.5% you have done this quarter, does it mean it goes up to 14% plus when that happens, or it doesn't translate that way?
Yeah. So, Percy, if you see, just let me take, say, a KFC example. I think we've got one balancing act to do between pricing and the impact of that pricing on consumer demand. Therefore, we've taken 9% versus inflation of 18, been able to still hold on to very strong SSSGs, and despite 310 basis points in gross margins, our EBITDA margins just dropped by 80. Now, I mean, if we do another calculation and say, let's take mid-teens price increase, and if it leads to very poor SSSGs, then the leverage impact will vanish, and therefore it can have a detrimental impact on restaurant EBITDA. So this is something that, along with Yum, we are monitoring at a close level. We are not seeing commodity prices coming down at an overall level significantly. Some places it is coming down. For example, oil has come down. But for both the brands, inflation versus last year continues to be at this level. Now, are there opportunities to take price increases? I think we'll be very cautious about some of the price increases. So I'll say gross margins perhaps will see some marginal improvement towards end of quarter 3, beginning of quarter 4, but won't see any dramatic improvement in gross margins. Having said that, restaurant EBITDA in quarter 3, because of better sales compared to quarter 2, we will see some leverage coming out of that, and I'm hoping that restaurant EBITDA margins improve.
And just to add to that, Percy, we have always called out that our focus is more at the restaurant EBITDA margins level, and we always try and take the impact in our stride on gross margins and still deliver, sustain and improve upon restaurant EBITDA margins. So that journey will still continue, where while you may not see a full recovery on gross margins, marginal recovery, but our cost management and the SSSGs, which gives us leverage, will help us move towards that restaurant EBITDA margins, the ideal margin which we are looking for.
And if the input costs comes off in future, do you think you would retain that benefits, or in one way or the other, not through MRP but through extra promotions or something like that, a large part of that would get passed through to the consumer? What's your sense on this?
Percy, if it comes down, let's wait and watch if it comes down, Percy. And it would be all a combination of what SSSGs and what growths we are seeing at that point in time. And this is that we will take a call, Percy.
And one small question I had was on corporate expenses. The corporate expenses that I am deriving for this quarter are about 5.6% of sales, versus in Q1 it was 5.1% of sales. So there's a 50 basis points operating deleverage on a sequential basis. So am I reading too much into this, or do you think, I mean, there is scope for this corporate expenses itself to be like over the next 6 to 8 quarters can be 100 basis points driver of margins or something like that?
So first, again, we will not comment on a specific line and give a specific line guidance. Having said that, quarter 2 corporate cost is also impacted by the ESOPs grant which happened in towards latter half of quarter 1. So quarter 1 did not see probably the full impact of that. So that have probably contributed 30 basis points in this. Yes, marginal impact has also happened on account of leverage, on account of lower sales. As the revenue builds up happen, our corporate cost, which is a combination of corporate cost and regional teams, will definitely grow lower than the revenue growth. So you will see some leverage happening quarter on quarter, or more logically year on corporate cost, because on quarter seasonality also plays out. So you will see some leverage. I will not put that leverage.
And this ESOP cost of 30 basis points, does it continue into the coming quarters as well?
So quarter 2 is now representative of the ESOP cost. So it's full ESOP cost which have got built in. In fact, what may happen is after March 23, when some ESOPs gets vested, it may come down slightly, in fact.
Oh, okay. That's all from my side. Thank you.
Thank you, Percy.
Thank you. Ladies and gentlemen, in the interest of time and fairness to all participants, please restrict questions to 2 per participant. If you still have more questions, kindly join the queue afresh. We have a next question from the line of Nihal Jham with Nuvama. Please go ahead.
Yes, thank you so much, and good evening to the management. So a couple of questions. First, on the KFC part, as you're highlighting the seasonality, generally what is the impact from Q1 to Q2 in ADS that happens because of, as you said, higher preference of vegetarian in the areas you operate?
So Nihal, very difficult to put an exact ratio, because what happens is the religious festivals, the days can move between quarter 2 and quarter 3. And then last 2 years, COVID has actually played a havoc with trend analysis. So very difficult to put a actual number. For example, even this quarter, you saw Navratra, part of Navratra coming in September last week, whereas last year the entire Navratra was in October. So very difficult to put. What I can say is that this year the dip which we have seen is similar to the dips which we have seen in pre-COVID times.
Having said that, quarter 1, our overall ADS was in the region of 144. Our overall ADS in quarter 2 is 134. So that is the extent of the dip.
7% dip you are seeing in a way.
Give or take, because new store impact from quarter to quarter won't be high. But so that is the kind of impact we see over the full quarter, Nihal.
Understood. The only reason I'm asking was because you highlighted inflation, so if there was a exaggerated impact of footfalls or something, but I'll take the number that you're giving of this as representative.
Yeah, no, I called out that was one worry that we had, that with inflation and with vegetarian days, would it impact transactions? But we are really happy with the kind of SSSG growth that we have seen, because dine-in has been strong. Their transaction growth has been strong, and we have also seen it translate into SSSG growth also.
Understood. Taking two questions on Pizza Hut. First is if you could again highlight on the flavor fund which you highlighted since July you've been promoting, and second is Vijay, if you could separately call out the margins for the new format stores, if that is the right, then I'll be done here. Thanks.
The second question first. We have said that the stores which have opened from April 18 onwards, and it's not a new format, it's all we operate is omnichannel stores, whether it's old or new. The April 18 onwards are more compact ones compared to the size which we were operating earlier, which we inherited in legacy. So the compact ones are delivering anywhere from mid to high teens.
Yeah, and on flavor fun, the response has been very positive. I am loath to call out a specific number on flavor fun because it's just really too early days. And while we always say that there is a seasonality impact on KFC, there is also some seasonality impact that happens in Pizza Hut also. So I think we should wait for 3-4 quarters, look at how the specific innovation goes. Undoubtedly, it is leading to transaction growth, and from an anecdotal basis, the kind of customers we are seeing coming to our stores and ordering is definitely, these consumers might not have come in the past. So that value layer under 100 rupees, like we called out even in the last earnings call, is an important future driver of growth. I hope we answered your question, Nihal.
Very much. Thank you so much. I'll come back in the queue.
Thank you, Nihal.
Thank you, sir. We have next question from the line of Devanshu Bansal with MK Global. Please go ahead.
Yes, thanks for the opportunity. Sir, I wanted to check what is the typical growth trend in ADS from Q2 to Q3 because Q2 generally is a weak quarter for KFC. So if you can just help me with the historical trends, it would be helpful.
It could, see again, ADS is also a function of how many new stores you are opening. When you look at the historical trends, we were not expanding so much, so that may not be the representative. The new store additions do dilute to some extent the overall ADS. Having said that, we have seen a drop of 5 to 7% vis-a-vis quarter one. Something of that in that range. It could be anywhere between that 4 to 8%. So I would not put a specific number to it, but that could be the range on quarter 3 versus quarter 2.
Okay. And sir, for Pizza Hut, it has been a very encouraging performance with 23% SSG. I just wanted to check if it's an element of low base for you in the last year.
Devanshu, Sanjay here. I just want to interrupt. I think I heard Vijay say decrease in quarter 3 versus quarter 2. Actually, it is between 4 to 8% increase in quarter 3 versus quarter 2.
Yes, sir, I got that. I understood it as an increase only. Yes, sir.
Fair. We just wanted to clarify for the benefit of everyone.
Yeah. There are 260 people on the call, so there shouldn't be 260 minus Devanshu, all of them freezing and saying, my God, is quarter 3 going to be lower than quarter 2? So I just clarified for that sake. Go ahead with your question again, please, Devanshu.
Yes, sir. So I was indicating that Pizza Hut has seen a very encouraging performance with 23% SSG this quarter. I wanted to check if there was any sort of a low base element for you last year for Pizza Hut format due to operating conditions, etc.
So I would say there was very marginally lower base. I would say malls were at say 90% recovery last year versus what they would normally be. But I think it is minimal. So base is not the issue.
Yeah. So marginally, yes, small impact and maybe a pocket territory like Maharashtra where the conditions got slightly more favorable in operating from October onwards, September towards end September. But then that's a marginal impact in the base.
Got it. And lastly, sir, if you can talk about the trends in terms of SSG for the festive season, it would be very helpful for both the formats.
Sorry, just repeat. So the festive season is over. So we have given you the SSSG numbers, the quarter numbers. Are you talking about quarter 3 or what are you talking about?
Yes, sir. Festive season in quarter 3. Some outlook, if you can provide, then it will be very helpful.
We can predict our business, but we are not soothsayers here, Devanshu, and therefore what Vijay said, roughly we have seen 4 to 8% increase over quarter 2. I think that's about as much that I am able to perhaps predict.
That's for KFC, just to call out, clarify again. Pizza Hut does not get so impacted by seasonality anyway. So quarter 2 was the best ever quarter. The EDS of Pizza Hut, which was 64,000 in quarter 2, does not have any seasonality impact. So we hope we continue on the same trajectory for Pizza Hut.
Got it, Vijay. Yeah, that's it from my end. Thank you.
Thank you, Devanshu.
Thank you, sir. To ask a question, please press star 1 on your touchtone phone now. We have next question from the line of Kapil Jagasia with Edelweiss Broking. Please go ahead.
First of all, congratulations for a great set of numbers, sir. So my first question is, Hello?
Kapil, you're the first person who's congratulated us. Normally, Percy is the first person who says good set of numbers, but this time Percy for some reason was very muted. So thank you, Kapil.
Sure, sir. Sir, our store opening run rate has been very healthy in H1. So would we be eligible for incentives from Yum this year too? Like if yes, then what would be the quantum?
So just to clarify, I think you are referring to the incentives which we actually had last year. So right. As per our contract, every year we incentives. We have been getting incentives over last 5 years. We will continue to get incentives over next 5 years as well. That's not going to change. What we called out last year was there was some additional component on account of COVID. Because of COVID, our targets were revised and we were given some additional incentives. That's all we have called out. So the current set of numbers are representative in terms of incentive calculations. You will not see a reduction in terms of incentives. You will not see an increase in terms of incentives.
Okay, that's very much clear. And I just wanted to understand your takeaway channel because, if I just see, in terms of during COVID, probably, people might be stepping in and taking away the pizza or KFC items. But now with, nothing there, no restrictions there, would it be clearly a dine-in or a delivery channel? Because I'm just trying to understand why the takeaway is still at 20% of sales. Like what is any drivers for it or how you see this channel going forward?
So takeaway has always been a double-digit channel for us, even in the past. And proximity to store, enables this takeaway. In many of our mall format stores and drive-through stores, people, so when drive-through format also, we say that when a person purchases in the drive-through, that is passed under takeaway. Having said that, I think now I'll just refer to a global trend that we are seeing, and perhaps that will play out in India sometime. If you look at globally, delivery prices are substantially higher than either dine-in or takeaway prices. And apparently there is a global trend where consumers look at these delivery prices, and if they are in the vicinity of the store, prefer to come and take away because it is a little more economical. Perhaps something like that we are seeing in India, because our takeout portions are slightly better than what has been there in the past. But again, compared to what happened during COVID, it's not better than what happened during COVID, so it's come reduced a little bit. So I think it's traditionally been a strong double-digit contributing channel for us, and the behavior that started during COVID period when takeaway increased, that sort of continues even when COVID is off, and neighborhood restaurants and access to a restaurant drives really takeaway.
And just to add to that, our omni-channel strategy, where all the three channels are available, actually puts us in a strong position that you can take advantage of one channel versus the other. All the three channels are available in Sapphire formats, be it Pizza Hut, which is omni-channel, be it KFC, which is omni-channel.
Did that answer your question?
Mr. Kumar.
Vikram, we are hearing some disturbance. Maybe you can take it over and we can move on to the next caller.
Sure, thank you. We have next question from the line of C. Kishore with Chola MS. Please go ahead.
Yeah, hi, good evening. Thanks a lot for taking my question. I just want to understand what is the average the size of the new stores that you're opening. That's my let's say I want to understand going forward. Would it be safe to assume that the future would be towards, let's say, smaller store sizes so that the unit economics actually work out better? Thank you.
So our sizes for KFC are in the range of 15 to 1600 square foot, Pizza Hut in 1200 square foot. The reductions in sizes have happened over last 5-6 years. That's what I want to call out. It's not just a COVID phenomena that we have cut down the sizes. It happened with calculations in terms of covers, table turns, and with the advent of delivery channel, partnering with the aggregators meant that we can be a more omni-channel player. So that's how the reduction has happened. While the reduction in size has happened, again, just to clarify, not impact our capacity to serve customers. So the ADS throughput can be considerably higher than what we deliver right now. At the levels where we are, we don't expect in the medium term for a dramatic or a further reduction in these sizes as we move forward, because you require X amount of capacity, sitting capacity, for your dining channel to be relevant. Any cut downs from here on would compromise that particular channel.
Fair enough. Thanks a lot.
Yeah. Thank you, Kishore.
Thank you. We have a next question from the line of Ashish Kumar from Infinity Alternatives. Please go ahead.
Thank you, sir, and congratulations for a good set of results. Sir, on this, if you compare a pace of store addition, while we've kind of come up significantly from where we were last year, the question which I have is that when we compare to a peer group, they seem to be opening almost double this number of stores on the KFC plus Pizza Hut India. How do you think do you think that we have a part to kind of catch up with them in terms of the same sport? Because from a GDP perspective, we kind of split the GDP 50-50, right?
Yeah, so I think the pace of our expansion is in line with what we have said consistently over the last 1 year that we hope to double our restaurant base of about 550 stores at the end of December 21. And that gives us roughly in the region of 130 to 160 stores. Between these numbers, and all three businesses, Pizza Hut, KFC and Sri Lanka, will be roughly be able to deliver this kind of pace of expansion. Now, this is what we are happy and comfortable with. I think it is a factor when you look at pace of expansion. It is pace of expansion into the ADS that you are able to get out of a new store. And if you look at that, I don't think we are compromised in any way with respect to our peers.
So just to add, Sanjay said double, he meant doubling in 3 to 4 years time, vis-a-vis the numbers which we had in December 21. And again, our guiding factor would not be what peer set is doing. Our guiding factor would be our levels, our strike rates, our paybacks. That's our internal measures which we use, and that's where we feel we are comfortable with doubling the count over 3 to 4 years. On the point which you just made that GDP-wise the territory distribution is 50-50, I would just like to clarify the territories which KFC operates in. For us, they contribute 56% to India's GDP. For Pizza Hut, the territories which we operate, they cover roughly 57% of India's GDP.
Yeah, which is where I was coming from, and maybe yes, you are right that this is in line with the guidance that we have given. But given the fact that we're seeing an environment wherein the shift towards branded players like yourselves is significantly higher, if I were to say, does it make sense to and we have a balance sheet with a very healthy cash accrual and a healthy internal accruals. Does it make sense to kind of accelerate the pace of rollout, given the fact that you have a higher footprint of the country? It's a question of, if you don't do it, somebody like a Popeyes may come and kind of capture the space. It's a question of a land grab, right, at some level?
So I don't think it's a question of land grab, Ashish. Like I said, there are many things that need to be balanced. At this rate, the ADS that we get and therefore the new store paybacks that we get are healthy. I think anyone, I think it'll be, or there'll be few players who can match this rate of expansion, deliver the kind of returns that we are looking at. So short answer is, this is the rate of expansion that we are looking at this stage.
Okay. And coming back to, and sorry I missed a little bit of the call when there was an initial question on the gross margin. Do we believe that we can get back to our historical gross margin in the next couple of quarters?
So referring to KFC in particular,
yes, absolutely.
KFC in particular, yes. So while again the gross margin drop of 300 basis points happened, our restaurant EBITDA dropped by only 80 basis points. So that's the way we are focusing. The idea is not to take a price increase with inflation and probably potentially impact our revenue and transactions. So we are happy with where the price increase stays right now. Yes, marginally we expect the gross margins to come back towards second half of Q3 and starting Q4. But it will be on improving the restaurant EBITDA, which would happen with the improvement in sales, which we are anyway seeing in Q3 over Q2 because the vegetarian days are now over in terms of the festivities. But the focus is more on the restaurant EBITDA margin and how do we sustain and drive restaurant EBITDA margins.
Right. And
thank you, Ashish.
Sir, I'm sorry to interrupt. Kindly come back in the question queue. Thank you. We have next question from the line of Jignesh Kamani with GMO. Please go ahead.
Hi, gentlemen. Just on the gross margin front, we have seen the milk prices increase by 3 to 4 rupees last month, and hence cheese and all the other products. So do you think that still some of the element of the gross margin and raw material is still continuing to rising and will have a further impact on the gross margin in second half? At least for the pizza, if not for KFC?
Yeah. So I mentioned this right in the beginning that there are some items where prices have come down, some items where as you rightly said, milk prices have gone up, and therefore potentially over the next 3-4 months have an impact on dairy products that we consume also. So overall, I think inflation will continue at the levels that we have seen in the first half. So I'm saying the deviation from this will be marginal. It's not going to go down dramatically. It's not going to go up dramatically.
Understood. Second thing on the flavor fun, based on the initial experience, are we seeing more down trading or new customer is taking care of any small down trading is happening?
So like I said, it's too early to call it on flavor fun. It's just that we are getting, I'm sure, we are getting higher level of transaction growth than we have got earlier. So net it is positive.
Sure. Okay. Thanks a lot.
I'm not going to go into great specifics on this, Jignesh, so forgive me for that.
No, thanks a lot.
Thank you. We have next question. Ladies and gentlemen, please restrict questions to per participant. We have next question from the line of Hiru Tejwani with Motilal Oswal. Please go ahead.
Good evening, Sanjay and Vijay. First of all, congratulations on the stellar numbers that we see on the process. So my question is on a very comprehensive and a macro level to Sanjay. Other than India or Sri Lanka, like in the QSR space, other peer group are growing in other countries. So how? So it's obviously from the question on increasing stores. Would you look at strategically introducing any other country in the near future?
Oh, that's too hypothetical a question, Hiru, at this moment.
Having said that, Hiru, we have always called out in terms of our strategy that apart from organic growth in terms of KFC and Pizza Hut restaurant additions, in terms of inorganic growth, we would love to have a third brand at some point in time, if not in the short term, maybe in the medium term. And that's where we will leave it at. Now, whether it could be new territory or new brand in India, it's too early, too hypothetical to comment.
I think largely one of the considerations is that it should be able to offer similar kind of growth trajectories as India offers. So if anything that is not offering the kind of India growth trajectory on another territory, then I think we will be very, very circumspect.
And the mantras for those identification of brand we have listed in our annual report. So if you go to page 35, there are 7 mantras which Sapphire defines where you want to have scale and success both. Then that would go into our choice of that third brand. So you can refer to the page 35 of our annual report as well.
Sure. Thank you.
Thank you, Hero.
Thank you. We have next question from the line of Kalpit Narvekar with Alliance Global Investors. Please go ahead.
Hello, sir. Good evening, and congrats on the results for the quarter. I had 2 questions. One was, I want to understand how discretionary is the category. So, essentially, if you've done any studies on the demand elasticity, say, at the Yum level or for the product categories for say KFC and Pizza Hut, right? So, if how does price hike affect volume growth? Let's say in past cycles, if you've done any studies, if you have any sort of color on that.
Yeah. So Kalpit, actually we are in new territory here, and I'm just looking at so we are in new territory here. Over the last 5 or 6 years, we've not had an inflation of this level, and hence there is very little past data to fall back on. I'm just looking at my old consumer product experience that says that in general there is an impact on any discretionary income category. There is an impact when you take severe price increases. So the best way to find out actually is to experiment and say so in general, we feel that if we are able to restrict price increases to in the region of between 60 and 70% of inflation, and then find economies of scale elsewhere, it works well because the product then becomes more affordable over a period of time. I think we have used similar kind of understanding when we have taken price increases this year also. But there is no hard and fast heuristic that shows the demand elasticity. I think we've just got to do something and then see how it plays out. I think the fact that we have kept price increases to the level that we have in Q2 compared to the inflation, and it's borne out with SSSG, means that at least right now it is worked in a quarter that has gone by.
Great, sir. That's helpful. And my second question was on the delivery piece. So how much of the delivery piece is through our own delivery system, and what is the strategy in terms of expansion of our own delivery network?
The breakup for both the brands would be different. KFC would be 90% approximate, and I'm giving you very approximate numbers, 90% through aggregators and the rest delivery. Pizza Hut would be 80-20, this ratio. So our plans for our own delivery in terms of our systems, our app, the kind of offers which we have on our platform, they continue to be there for last 2-3 years, and they continue to grow well. What's happening at the same time, aggregator continues to pump in money. They are growing really well. So the mix is not changing. However, our own delivery as well as aggregator, both the platforms are growing healthily.
Yeah, so typically we would have stopped our call was for an hour, but we are quite happy to continue it if the people on the call are also willing to continue. So we'll take our next call, therefore, Bikram.
Thank you, sir. We have next question from the line of Harsh Mulchandani with KRIIS PMS. Please go ahead.
Thank you for the opportunity. Congratulations, sir, for a good set of numbers. I just wanted to understand that do you track the set of repeat customers at your end, and how does that number look like on a quarter-to-quarter basis?
So I don't have those numbers offhand with me, I must confess, Harsh. So, if necessary, we can get back later, but I don't have those numbers offhand with me.
Okay, sure, no worries. And I have another question on the prices. So just want to understand, operate across states. So your prices are consistent across states where you operate, or they are different?
Yes. They are consistent all India. There might be, so there are...
They are consistent across India. They may be different across channels. So for example, delivery channel may have slightly higher prices for KFC in particular. In Pizza Hut, even that's not the case. Otherwise, from state to state, territory to territory, the prices are consistent.
Yeah. We also have some premium price stores. But that's about the difference. Otherwise, pricing is consistent across the country.
Got it. Fair. And just to compare it with the price with the other operator for Pizza Hut, which operates in India, so the prices with them is also similar, or you have a different pricing power?
It's pan-India similar. So irrespective of the stores are operated by the sister franchisee or by Sapphire, the pricing strategy is consistent, not just for Pizza Hut, even for KFC, across all states, all territories.
Got it. Fair. Thank you so much.
Thank you. We have next question from the line of Ameya Gawande with Metaverse Equity Fund. Please go ahead.
Yeah, thank you for the opportunity. So, sir, my question is, what growth you are anticipating within the next 3 years, particularly in Sri Lanka?
I don't think I can venture that answer, Ameya. What growth?
So Sri Lanka, as we have called out already, this year we are seeing 20 to 30% growth, and the macroeconomic situation, while it has stabilized, continues to remain critical. So we'll be very foolhardy to probably try and predict 3 years from right now for Sri Lanka. We'll take a quarter at a time. Let's see in next 6 months' time where we reach, and maybe then we can have this conversation.
Sure, sir.
Thank you. We have next question from the line of Poojan Shah with Congruence Advisors. Please go ahead.
Hello. I just wanted to know what is the advertisement spend we are doing on the percentage basis?
So as per the contract with Yum, we are required to spend 5% for a national campaign, which we contribute to Yum along with the sister franchisee, which is used for pan-India marketing, and 1% for local sales marketing, which we spend internally.
Okay, so as geographical wise, our sister concern and all and our company, do we have any segregated advertisement spend, or we have collective advertisement spend on a basis of the franchise base?
So the segregation is on that 1%, where it's local sales marketing, where we spend into our territories. For the 5%, it's a national pool, which is used for pan-India marketing.
Okay, good. Thank you, sir.
Thank you. We have next question from the line of Dhairya Trivedi with DJP Investments. Please go ahead.
Yeah, hi. I have a couple of bookkeeping questions. What is the likely tax rate for this financial year?
So this financial year, it's unlikely that we will have a tax outflow because we have enough carry forward of losses. I guess we will get into the tax time next year, maybe towards second half probably. And then going forward a year later, we'll fall into 25% tax regime. But that's probably a couple of years away.
Okay, got it. And another one on the royalty front. What is the royalty that we are paying to the master franchise at the current stage?
So the overall
first of all, we don't pay to a master. We are a master franchise. We pay royalty to Yum.
Yeah, to Yum.
Yeah. So as per our agreement, it's 6.3%. But again, there would be we have called out there would be waivers depending upon the store opening plan. But the base number is 6.3%.
And is it likely to go up in the next year or so?
So our royalty of 6.3% has been consistent for last few years. In fact, for Yum, it has been consistent globally. We don't expect this to either come down or go up. That's the rate which Yum follows globally for quite a few years across all territories.
Okay, got it. Thanks.
Thank you. Ladies and gentlemen, we have reached the end of the question and answer session, and I would like to hand the conference back over to Mr. Sanjay Purohit for closing comments. Over to you, sir.
Yeah. So first of all, thank you all for joining. We had a really good question answer session at the end of a quarter where which was potentially challenging, but we have been able to navigate these turbulent waters quite well. And from a demand perspective, both brands were strong. In Sri Lanka also, business was strong. And our old adage where we said that let's not look at gross margin, but see what is the impact of price increases on volume. And if we are able to maintain volume and therefore grow same-store sales growth, we are able to get leverage. And that's how it has played out in quarter two. And therefore, our restaurant EBITDA margins have been quite strong. The drop versus last year quarter on KFC has been quite minimal, and the India restaurant EBITDA, both brands put together actually went up by 40 basis points. I'm quite looking forward to quarter three and quarter four and ending the year also on a strong note. Having said that, we will see you at the turn of the new year, and therefore best wishes for the new year in advance to all of you. Thank you.
Thank you very much, sir. Ladies and gentlemen, on behalf of Sapphire Foods India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.